Thank you, and thank you for the opportunity to speak with you this afternoon, Mr. Chair and members of the committee. And I am one of those products of the single mom who had affordable housing, who was able to purchase her house using a self-help housing and leverage that to send 2 girls through college with graduate degrees. So you're looking at the product of what Ben was actually talking about. So my name is Tia Boatman Patterson, and I'm the Executive Director with the California Housing Finance Agency. California Housing Finance Agency has a 40-year history of supporting renters and home buyers. We were created as the state's affordable housing bank to administer programs that create safe, decent, and affordable housing opportunities for low and moderate Californians. We are basically the companion or the sister agency to housing and community development. Ben mentioned that the majority of his programs and one of his stellar programs, which is the multifamily housing program, which is a gold star for that gap financing that the state provides, targets their resources to 30%, 2/3 to 30% AMI and below. Well, when you look at my multifamily portfolio, the majority of my funds are financing developments that go to the 50 to 60% AMI. So you can see where we work complementary with one another. Our historical business model has been to issue tax-exempt mortgage revenue bonds to fund loans, but the financial crisis has limited the use of that tool. We've had to use new financing tools to preserve our emphasis on low-risk lending while still enabling us to compete in the market. We are completely self-supporting, and our revenues and expenses are independent of the state's general fund. In 1975, we were funded by the state with $20 million, and we have now grown to a $4.3 billion in assets with a housing bond indebtedness of $2.5 billion. CalHFA has funded and administered dozens of programs through our existence, adapting to the change in market conditions and the evolving housing needs. I'll provide you with an overview. We've funded $20 billion in mortgages for 190,000 first-time homebuyers. We have created 30,000 affordable rental housing units for individuals and families. We've assisted 61,000 families in keeping their homes and avoiding foreclosure. We have provided housing for those with mental illness who are homeless or at risk of homeless by providing $360 million in Mental Health Service Act funding to create 25,000 regulated MHSA units. When you sum it up, we have helped more than 280,000 families find and keep a place to call home. Housing is a huge driver for California's economic well-being, and the financial crisis has especially big impact on the business of the housing sector. It also had a big impact on the California Housing Finance Agency. And over the last several years, we have focused to improve and maintain our financial stability. Now, we are confident that we are on sound financial footing to build programs for the future. This gives us a means to work on expanding our business by expanding access to capital, increasing our capacity for lending, developing new products to meet the needs of today's borrowers, and taking advantage of our improving economic conditions. The major rating agencies, both Moody's and Standard & Poor's, have consistently affirmed our positive credit rating, most recently just last month. We have 2 main revenue-producing divisions, our single-family and our multifamily. I'll tell you a little bit about our single-family programs. Our single-family division works with dozens of private lenders. We do not provide direct lending to home buyers, but we work with a group of preferred lenders so that we can be partners with our private partners. We work with small lenders like Academy Mortgage to large multinational banks such as Wells Fargo to finance mortgage loans to low and moderate income Californians. We have statewide partnerships with lenders, local housing agencies, nonprofit builders, developers, realtors, and others to make sure our message gets out to the largest number possible. Currently, instead of issuing tax-exempt mortgage revenue bonds that I mentioned to you earlier, we're using a fee-based TBA lending model in which we purchase conforming loans from our preferred lenders and then resell these loans on the secondary market. This financing model carries extremely low level of risk. The loans that I am purchasing are conforming loans to the GSE requirements, which means that you have to meet certain credit criteria, and they are available to low and moderate income. In addition to our first mortgage, we also fund several forms of down payment assistance, such as low-interest deferred payment loans, mortgage credit certificate program, and an energy-efficient loan, which help homebuyers improve their home energy efficiencies. Since 1975, CalHFA's single-family lending has financed $741 million in down payment assistance loans and $20 billion in first mortgages, helping California's families purchase their first home. Since relaunching our single-family programs, because we did suspend our lending between 2009 and 2013, but since relaunching our programs, the demographics of our low and moderate income buyers look very much like California. 50% of our borrowers are Hispanic, 36% are Caucasian, 9% are African American, 4% are Asian, and 1% in other classifications. Single-family production projections for this fiscal year are estimated at 3,400 first mortgages worth $900 million and $40 million in down payment assistance. Our multifamily programs is our other generating division of California Housing Finance Agency. The stock of affordable multifamily housing in California continues to age, so our programs provide financing to acquire, rehabilitate, and preserve multifamily housing developments in California and to assist localities with bond issuance for financing local housing development. We did notice that after the elimination of redevelopment, some of the housing and the technical skills that were available at a local level had been lost. So we reinstituted a conduit issuance program so that we could provide those conduit finances in partnerships with local communities that wanted to be able to have conduit bond issuance financing. And that program has exceeded our expectations. We're able to actually take the fees that are generated from that program and recycle them back into our affordable housing programs. CalHFA's multifamily lending has financed nearly 30,000 affordable housing units since 1978. We are primarily a first lien lender using tax-exempt bonds to finance the mortgages. Currently, we are building our multifamily lending program on an exclusive HFA product. HFA are housing finance agencies, so this is a product that's only available to housing finance agencies nationwide. The product was introduced by the U.S. Treasury in 2015 and purchases FHA risk share loans participant rates for comparable multifamily Ginnie Mae securities. So this is a partnership that I think my colleague over here probably had a lot of his hand in, but it's a partnership in which HUD and the U.S. Treasury came together, and they're going to actually purchase our paper if we underwrite to their guidelines, so I don't have to issue bonds, but I will be able to finance those programs, and they're going to buy that commercial paper at a very low interest rate, which I will be able to now pass that on to developers. We also have a conduit issuer program, which I talked about in partnership with the local governments. This helps both nonprofit and for-profit developers in partnership with the local governments to access tax-exempt bond financing for families and senior affordable housing developments. And this issuance brings a small operating cost, like I said, back to the agency. Projections for our multifamily this fiscal year, which our business was also suspended, but we're now projecting $190 million in first mortgage lending and $300 million in conduit bond issuance. This production will create or preserve around 2,500 affordable housing units, and we also oversee the monitoring and compliance of all of our regulated units. We also serve as the traditional contract administrator for federal multifamily rental subsidy funds for the Federal Department of HUD and provide program compliance and monitoring for that federal assistance program. Another program we administer, and this was in partnership, and Ben talked about this, was the Section 811 Project Rental Demonstration Program, which was designed to assist elderly, disabled individuals moving from institutional facilities to apartments. This is in partnership with the Department of Housing and Community Development, the Department of Healthcare Services, and the Tax Credit Allocation Committee, another example of our collaborative efforts in bringing in those federal dollars. HUD has awarded California nearly $24 million so far, and we will continue to seek additional funds in future rounds. I'm proud to report that California was the first in the nation to help residents under this program make the transition from care facilities to independent apartment living. In the development of affordable multifamily rental projects, multiple funding sources are often necessary. Loans are typically used in conjunction with federal tax credits or often local subordinate loans. Because these loans are funded by bonds, the federal statutes restrict these units to 60% area median income or below. And so we've heard a lot from legislatures about that, those, especially in our high-cost area renters, who are not able to be assisted by any of the state housing programs because they're over 60% AMI, but they're still low income. And the rents that they're building and the developments they're building are all luxury developments. And so what I have committed is to continue to work with my partners and to continue to work with all of you all to look for creative ways in which CalHFA, so that we are not utilizing or competing with federal dollars that should be given towards our most vulnerable populations, to look for creative ways in which we can incentivize the market to build or reach down and help incentivize them to create mixed income developments. And so I commit to you all that I will continue to work on those. CalFHA also administers the Mental Health Services Act housing program, which was created in 2007 to finance permanent supportive housing for individuals with mental illness and their families who are homeless or at risk of homelessness. This program was started with an initial allocation of $400 million from Proposition 63 funds, the Mental Health Service Act. The units created have provided housing to serve individuals and families, including seniors, transitional age youth, and veterans. To date, CalHFA has dispersed approximately $360 million for 2,500 regulated MHSA units and has been leveraged into $3.8 billion in funding for the creation of more than 10,000 units of affordable housing. I have to tell you that MHSA dollars was also worked in collaboration with some of the programs delivered by my sister agency using their multifamily housing, supportive housing program funds. The initial goals we've exceeded in what was set out when we initially had that $400 million allocation, and that was created via an executive order and a partnership and an MOU. The existing MHSA housing loan program will end in May of 2016 when the Memorandum of Understanding with Department of Health Care Services expires. The success of the program prompted CalHFA to reach out to localities to find out whether there was sufficient interest for CalHFA to create a new program that would allow counties to contract directly with CalHFA to administer their MHSA funds set aside for housing. I have to tell you that we did this prior to Mr. DeLeon and you all announcing your MHA housing program, but we did reach out because we wanted to make sure that that program or that population was continued to be helped. We now have over $30 million in commitments from local government, and CalHFA will move forward with what we call our Local Government Special Needs Housing Program. The program will not need any legislation to implement and takes advantage of existing state-local partnerships to provide additional housing and supportive services. Lastly, CalHFA oversees the federal hardest hit funds. There were 18 states in the nation that were declared hardest hit funds because of our foreclosure rates back in 2007-8. We administer that through our Keep Your Home California program, which was allocated almost $2 billion of federal funding to help prevent foreclosure. Keep Your Home California gives assistance to low and moderate income buyers. These home buyers can receive up to $100,000 in mortgage payment assistance. One of the limiting factors has been the servicers must opt into the program, although the number of servicers we have participate continues to increase. To date, we have over 250 participating servicers. The Unemployment Assistance Program helps homeowners who are collecting unemployment benefits from EDD, the Employment Development Department, and the program makes their mortgage payments up to $3,000 per month for up to 18 months. This program has helped over 41,000 homeowners. The Mortgage Reinstatement Program helps homeowners whose hardships have ended, but who have found themselves with their mortgage payments in arrears. We'll pay those arrearages up to $54,000. More than 10,600 homeowners have taken advantage of this program. The Principal Reduction Program can make the most difference in that it can provide up to $100,000 per household. The assistance can eliminate severe negative equity or cure affordability issues by reducing the homeowner's outstanding principal balance, which often results in significantly lower monthly payments. This program has helped more than 8,100 homeowners achieve a sustainable mortgage payment. The Transitions Assistance Program helps people who have exhausted their other options and must leave their homes. It gives up to $5,000 to help with moving and transition expenses, and we've helped nearly 1,000 families use this program. Our newest addition to the Keep Your Home California is the Reverse Mortgage Assistance Pilot Program, announced about a year ago. This program helps financially distressed California homeowners who have an FHA home equity conversion mortgage and grants up to $25,000 to help with property taxes and the homeowner's insurance while homeowners complete comprehensive counseling services to enable senior homeowners assess their overall budgetary health. Nearly 600 homeowners have been helped through this program. Most recently, about 2 weeks ago, the U.S. Treasury announced the extension of this Keep Your Home, our hardest hit funds, which was set to expire in 2017, but they've announced the extension of that program till 2020, although we were going to be using all of our money and we were on track to use all of our money. But we're also anticipating that we'll be awarded a minimum of an additional $215 million for the state of California to continue in our foreclosure prevention efforts. Keep Your Home California has been a great success, with $1.3 billion going to over 61,000 qualified families. Although the headlines are still are telling us about the housing turnaround, we still realize that many families are still affected by unemployment and the housing crash and the drought. So Keep Your Home California continues to be an invaluable resource. That concludes my presentation, and I'm available should you have any questions.
Thank you for both of you. I'll start out with some questions. Like we're looking at a range of ideas. We're looking at ideas that will benefit the supply of affordable housing, and such ideas as the low-income housing tax credit ideas. We had 2 bills last year. The legislature approved them, bipartisan support. Governor vetoed both of them. We now have Senator De Leon's one that targets the mental health Prop 63 funds for homeless, mentally ill, $2 billion bond program. We have the idea of a state housing bond, and I think there's some bills in the Assembly they're looking at for general fund, allocations for housing. I've seen various things. Has there been a review of the 2006 bond and sort of a lessons learned and how we can improve the leveraging of those bond dollars if we do another bond, contemplate doing another bond, in terms of its economic impact, the maximization of number of housing units, fiscal impact on the state of California? Has that been done yet? Sort of a look at the bond we did 10 years ago. It was passed in 2006. It'd be nice to know what the economic and impact was and how many housing units did we get out of the full amount of money that we had. It was about $2.85 billion, the bond was. How much leverage was available there?
Yeah, I know we have the leverage calculations, and I'm happy to get back to you with that, as well as to check in with the team as to what we have in the way for formal evaluations. I did say, and I will say again, I think that that work we did under that bond, that the bond has been part of what has informed how we've deployed the AHSC program and the VHHP program. There are a lot of things in the delivery of those programs that come directly out of the experience that we had with the bond funds. And I think, for example, I mentioned also the cost containment study that was done a couple of years ago, pulled a complete data set, primarily from the TCAC, from the tax credit treasurer side, but paired that up with MHP and CalHFA data as well to look at ways in which we can be more effective in our delivery system. The results of that study are not suggested that there's an ability to have a huge impact, because often a lot of the costs and the effectiveness actually derive directly from the depth of the income targeting or our need to make sure that housing is in fact done in a long-term affordable, quality way. I think there's a lot of very valid reasons why the delivery system costs what it does. There's also a lot of very valid reasons why some programs are more expensive than others. For example, it actually, in fact, is more expensive to take somebody who has been homeless off the streets and house them, but obviously the savings that you get on the back end from doing that are commensurately greater.
Right. How about tax credits? The bills were vetoed last year. We have AB 35 by Assemblymember Chu, $300 million tax credit bill, and then SB 377, which would increase the efficiency of the tax credit program to avoid federal taxation and then have really a cost. Another bill vetoed. That was by a senator named Jim Bell, so I was kind of interested in why those bills were vetoed, especially the one I had. It was kind of hurtful because it had no impact on the general fund, so I was kind of wondering why. It was kind of a scratch in my head after that. So
what was the governor's message on that?
he said basically for both that he was worried about the impact on the general fund, and one definitely, you could say the tax credit bill, $300 million one had an impact, but the other one simply was a way of avoiding, helping tax credit players avoid federal taxation for investing in tax credits. So it is actually no cost to the state. So it was a kind of bill that would not impact the general fund of the state, if that's the reason. So are those bills, are those ideas still in play in terms of the view of the administration to consider this year? Because we were told that maybe in the budget or other places we can consider those bills.
I have no reason to understand that they're not.
Okay,
but then
can you
again,
get back
it
to
is
me?
my 8th day on the job, so
Well,
I was going to
you're
jump
out
in
there.
and try to save him.
yeah.
Well, we want you to look into this, okay? I'm raising the issues because
We'll look
it's
into it.
like $300 million. I mean, housing, we could get a lot of housing bill for that.
Yep.
I have some other senators that have questions. We have Senator Leyva and Senator McGuire and Senator Wachowski and Senator Allen. They all have, the senators, the whole team has questions on this. This is really exciting.
Good afternoon. Ben, I want to thank you, Director. I want to thank you publicly for coming down to the district on Friday on your 5th day on the job, and we didn't kill you. As the chair of the Select Committee on Mobile Homes, we took you on a little tour of some of the mobile homes in Pomona, which could be affordable housing if done properly. So 2 questions, and we also talked a little bit about some of the frustrations we had, a little finger pointing at HCD when issues came up. So 2 just questions, maybe observations from your little tour on Friday, and then also I was happy to hear you say some realignment in HCD. I hope that means maybe streamlining things a little bit so it's a little less finger pointing. Thoughts
Yeah.
on day 8?
So first of all, thank you for giving me a chance to take a look at some of the mobile home parks. There are some 500,000 mobile home park homes for Californians today. It's a huge chunk of our workforce. Yes, it's clear that it plays an integral role in affordable housing needs. Literally, an affordable place for folks to live. I will say. We at HCD play a very key role in terms of actually overseeing those parks. So we don't play the only role. There are other local governmental entities that also get involved. But I do think that there have to be opportunities for us to be better communicators with our local partners in terms of helping folks understand those points of intersection. And also, I really do believe, and we talked a little bit about this, there have to be ways that we can fast track some of our investigative work and enforcement work, particularly when you have sort of the most egregious of violations in place, so that we can do a better job of holding owners' feet to the fire to make sure we get these properties up to a basic standard of living in a reasonable and decent time frame. So there's work to do there, but I'm confident we can make some progress on it in year to come. Yep. Yeah, likewise.
Senator Michael McGuire and Senator Wachowski.
Thank you so much, Chairman, and thank you for calling us together, and to your staff as well for all the work, and welcome both of you. Just on a few items in regards to HCD, and just want to start out with homelessness. Again, I think this will be a reoccurring theme, 8 days on the job, so hot day, I'm on the hot seat, right? But I think that the biggest issue that at least I see looking in for your agency, particularly in homelessness, is funding.
Yep.
And the lack of funding, particularly if we take a look at the ESG grant process, how few dollars there actually are. With 144,000 homeless in the state, 22% of the nation's entire homeless population, and 25% of our homeless in the state are veterans, we are not doing the job that we should be. I think and I will talk with you with a bias, is that represent part suburban, but one of the more rural districts in the state. And not one penny of ESG dollars go north of Sonoma County in California. So our most rural counties, and your staff is very aware, and like I say, you have an amazing staff. They have been in our office and working with other rural members, both on the Assembly and Senate side, of developing a new funding allocation. And the reason that we've seen rural counties losing out on very few millions that are available is because it's a competitive grant process. And you have a Trinity County or a Mendocino County, and Mendocino County has the second highest homeless population in the nation per capita, competing against an LA or a Santa Clara. And very poor counties, very few resources. And I just wanted to say thank you to HCD. It upsets some suburban counties where now ESG is going to have a flat amount for each county in the state. And then the other half will now be a competitive grant process as it always was. So at least we're starting to see some of those dollars moving forward with an eye towards housing first. Because again, not one dime has flowed north of the county of Sonoma. The other item is the agency's successes, and this is not at all based off of the staff that is there, but the agency's successes are in the past because you don't have the dollars that you need to be able to move forward with. And we're talking less than 30 million, I believe, in the ESG fund right now, statewide.
Right.
And for a state that has 38 million folks, it's an embarrassment. We got to be able to advance that because, like you had said, digging through the couch cushions is not a strategy for success, right? So appreciate the pro tem bringing forward the $2 billion homeless bond, which hopefully will put some of our money where our mouth is because I know that everyone's really concerned. And then the whole issue of affordable housing, I'd be interested in hearing where you're coming from on this. And I know this could be controversial with the governor, but have a different opinion on it, is redevelopment agencies. It's the only fund that we actually saw affordable housing being built. Since RDA went away, we've seen very few actually built in our communities, particularly in more urban areas like the greater Los Angeles region or the San Francisco Bay Area. And we need a similar initiative to actually put money on the ground, because what we know is, and I come from a very small community called Healdsburg. We had an amazing nonprofit called Eden who did a fantastic job with affordable housing. But the only way that they're able to do it is that RDA purchased a lot and bought down the price of the dirt so they can actually focus on the development. And right now, real estate is so expensive in so many areas of the state, cities and counties can't do it alone. So day 8 on the job, any thoughts on long-term funding, on being able to move forward on these developments that have gone away since RDA has?
Yeah, I can't comment on the second one and speak for the governor on that. Obviously, I would say on your first point about the ESG changes, you're onto something there. And I think part of what we are doing is, yes, it's a small pot of money, but the changes that we've made make it much more effective.
Absolutely, and I hope I wasn't coming off as being stinky about it. So.
And I think part of why you do want some ESG money to kind of go to all the counties is really because that money, in some sense, becomes an enticer.
Absolutely.
To actually get some systems change and actually change the way. I think for too long in the state we've seen homeless money not going to evidence-based solutions, really just kind of maintaining the status quo.
Right, you're absolutely
and so I think by putting that money out in a more directed way, but even in a small amount, we can have. And I think whether it's with the 811 program, with the NRDC, I think we are seeing this department and our collaborating partners really using the small amount of money that we do have to really focus on things that afford systems change and that actually change behavior patterns. And I think that is promising, and certainly were there to be more money, we could accelerate that. But I wouldn't say we're not delivering on the affordable housing goals at all, because we are.
I think that My own, again, not getting in a back and forth on this, where I think it's very difficult for the agency to deliver is if you don't have the dollars to be able to invest. And you have very few dollars to be able to invest, at least on the homeless side.
Right.
To make an impact in a county of less than 100,000, let alone a county who has millions of folks.
Right.
And frankly, that's the fault of all involved. And I'm not trying to point blame on the agency because I know you have a lot of wonderful, passionate, and talented individuals that work with HCD, so I'm not blaming you. But I think that we got to step up, right?
Yep.
And the problem's only getting worse. And I think the talk is really cheap at this point. And I think there is some frustration, quite frankly, on the legislature's point of wanting to be able to reinvest, but some unique and innovative ideas get nixed. So I think that there are some challenges that we need to be able to work through. And again, HCD, your staff, and not blowing smoke because you're here, they've been fantastic to work with in trying to be able to figure out a way to be able to deliver for rural because they have not seen the money as many as urban. So just want to
Thank you for that compliment. I'll take that back to the team. I appreciate it.